Hey traders, this is Blake Morrow with Trader Summit, and for the very first time I have Mr. Mike Shell of Shell Capital Management with us here today. Mike, how are you doing?
I'm good. How are you?
Good, good. You know, it's nice to have you here, and as I was mentioning to you before we hit the record button, it's always nice to have a fresh face on Trader Summit, somebody that I haven't talked to before, but I have followed you on social media for a while, and I really like your commentary, and I know you're a wealth manager, and we're going to talk about what you guys do over there at Shell Capital Management. But we are in a very busy week. We have the Fed that's meeting today, even though people are going to be watching this after the Fed meeting. But I wanted to ask, like, what's been your approach, generally speaking? What's been your approach for your clients as of late, and how defensive have you been? Because 2022 has been a little rough year for equity markets. How are you positioned, and how are you playing the market right now?
Well, I've had a good year this year. I was defensive early on, and so I run trend following and counter trend systems and volatility trading. So very active investment manager, and we also do comprehensive wealth management because my wife was a private banker for 20 years. But my main focus and the purpose of the firm is to manage our investment portfolios to help clients survive and thrive. And so survival is the risk management part, and thriving is the trying to create some asymmetry. So our program is called Asymmetry Managed Portfolios, and we've been positive most of the year this year because I'm trading the trends, and so when trends are down, we're out of it or short it, and when trends are up, we're long the trend trading also a very global opportunity set of stocks, bonds, commodities via ETFs or individual stocks. We do a lot of ETFs, and I started doing trend following programs 2 decades ago, and so times like this with my risk management systems and my asymmetric investment return program that's focused on absolute returns, and risk management's a really big part of it. So my risk management gets really tight, and we're dealing with investors that have $1 million or more, usually a few million dollars, who maybe a retired surgeon or somebody that's 50 years old or so, and so they're really more looking for risk adjusted returns and absolute returns. And so this year, I've just done a lot of trading, and just to be positive, to be in the green, and we're in the green now and have been most of the year. But like right now, we're mostly in sectors like consumer discretionary, technology, and communications, and was long energy earlier in the year and have been out of it, and then I think actually probably back in it now. Yeah, we're actually have some exposure in energy again from this recent counter trend move. So, today the Fed will be announcing that, any time. And if you notice, something I've tweeted about lately is the stock market has been up pretty sharply on the day the Fed is announcing, or on the day of the meeting, and then the next day we're seeing what we have. Yeah. So today it looks like the S&P is up 1.5%. And then, more than likely, we may see some downside tomorrow, possibly. But when you really look at the market, the stock market, which is what most people focus on, I think that I started to get, we were out of the market mostly, and I say out because I've probably been in and out 3 or 4 times this year. It's very, I'm very active in these volatile conditions, but
sure.
I started buying stocks June the 14th. I tend to go big early when I see those counter trend moves. Something that I've been doing this for 25 years, and one of the things that I've always focused on is sentiment, breadth. So I'm looking at when most stocks are already in an uptrend and above their 50-day, 200-day, 20-day, 50-day, 100-day moving average, when 80 or 90% of those stocks are already in an uptrend, then what I know from having watched that for 20 plus years is that that's usually a sign that at some point it'll roll over, and those who want to buy have already bought. And so when if you look at my Twitter feed, you'll notice that I'll post those breadth indicators, and I use a wide range of them. I've actually started out using point and figure charting, doing the bullish percents is where I actually started doing that in the late 90s. But right now, as of June, the breadth got really negative. The market is very bearish, surprisingly bearish in my opinion, because I've been in a position of strength, because we've not participated in the downtrend of the stock and bond market. I know global, people that are invested in a global allocation of stocks and bonds, the 60-40 is down, 18% year to date. So, and that's because bonds have gone down as much or more than stocks. The long treasury is actually down more than the S&P was. So, when you're in a position of strength because you've not had a drawdown, then what I do is I have a risk budget, and I can actually take risks. So I get to step in and start being more aggressive after prices have already gone down. So it was June the 14th when I started buying back in again and got very heavily exposed very quickly. That was because that was really a counter trend move, and my counter trend systems that I run was suggesting that stocks had already gone down and the supply, selling pressure was already there. Now, of course, we're a few percent off of that. The indexes have probably recovered 5, 6, 7, 8% from where they were then. It's not been, it's been a little choppy, but now we are, we're really looking at, some oversold conditions, but now we are with the Fed announcement. So this Fed meeting, I think, really is going to really drive, it's one thing to try to predict what the Fed's going to do. We know that Fed futures today are showing a 75% chance of a 75 basis points move and a 25% chance of a 1% move.
Yeah.
Irregardless, it doesn't really matter what they do. It matters how everybody else responds to it, and that's not very predictable. I think the only way we can have some predictive value in it is to look at the trend itself and look at what the market's doing and follow its lead. And right now, what I'm seeing is these indexes, broad-based, S&P, NASDAQ, all this. I look at the sector indexes a lot because we trade those ETFs, and also look inside those sectors and see where the strength is inside of each sector. But technology and is the number one. It's got the heaviest weighting. It's like 27% of the S&P, and it's up. Let's see, about 3% right now. And then discretionary is up over 2%, and then communications is up over 3%. It's actually up the most today. And those are the three areas that I've been focused on because although I'm not a fundamental guy, I'm purely price driven, quantitative. Those sectors are actually even undervalued this year. So according to the value people that I know that publish some things. Right now though, the key is that the primary sectors that are the heaviest weight in the market are above their 50-day moving average, and they're holding the line so far. I will not be surprised if it doesn't gap down tomorrow, but it could gap up. And right now I'm exposed. I've got positions where we're long stocks and have been since June. We've got a cushion because we've got some gains there, and so we're going in. We're going to let it rip and see how it goes. The next couple of days, and then respond accordingly. But as long as it stays in an uptrend, say the 50 days not my signal, but if it stays above the 50, I can say that I'll probably remain in those areas. So, well,
let me ask you this. So, going into the remainder of the year, because I know it's not fair to you, I want this video to actually, I want this interview to actually mature well in the next couple of days post Fed. But let's talk about the remainder of the year. Do you think that the stock market has put in its lows for the year? Are you going to be buying dips from here? Or are you looking to really sell rallies into possibly new lows? And I'm talking broad markets in general, overall.
Well,
And another question would be, how do you feel about yields where they're at? I mean, bonds are at an important inflection point going into today. Are you in the camp that yields are going to be moving higher throughout the course of the year, or maybe a little bit lower? What are your thoughts there?
well, I think in a in the short run, yields are short term overbought, and the bond price is short term oversold, or at least it was here in the last week or two. Now it's
Yeah.
that's I monitor TLT a lot, which is the long treasury. That's one of my favorites, and obviously it's not provided the crutch that it has in the past. TLT is one that we could normally jump into when as it is provided somewhat of a hedge,
Sure.
an indirect hedge, but that's not been the case, and I've not done very well with it this year. I've traded it a lot, but it's not been very profitable, only because I'm more counter trending it, and it's just kind of stayed down because of rates. I think more than likely, we are to made good point you made it. We are in an inflection point here, because in the short run, I've been bullish, and we're benefiting from being, from seeing, following the trend, which has been short-term upward direction. In the bigger picture, though, this, it certainly does look like an early stage of a bigger bear market, a more prolonged bear market, and that's all going to be hinging on inflation and the Fed and how they handle it. I think that I don't really have to predict what it's going to do. It's really more that I'm just going to be following it, whatever it does do, whatever the trends do. And as right now, if the markets can hold the line and continue to try to trend up, there's not a whole lot of buying enthusiasm right there. It's not there. There has been some really nice breadth thrust the last few weeks here, but it's still not been tremendous. It's not been a big V bottom, as they call it. So short term, this little uptrend is pretty consistent with what I expected to see. However, when you look at the trends, I've been trading trends for 25 years now. And when you look at these charts, what you got to realize is that as these prices have gone down, and they don't go straight down, they're doing this, and they start to trend back up, there's a whole lot of people back there that bought those dips, or that bought the peaks, breakouts, and some of them are trapped. And so, what we don't know is, we don't know how much resistance is going to be there.
Yeah.
And resistance is going to be, how many people are trapped in each one of those swings. And the challenge of coming out of corrections and with the patterns is that you're having to get through all that resistance that could be present. A lot of people mistakenly say there is resistance there. Well, there's not any resistance until it is. But you've got to get through all those all those lows and highs that are back in the past, and that's going to be a real challenge. Is kind of looking to see if stocks and indexes or whatever can break above those levels, which will let us know that as they do break above that, there's not a whole lot of people trapped. Because see, you said it yourself. Are you going to be selling into this? Well, I probably will at some point. But for me, my position, I'm not a day trader, but I'm very, very tactical. I can, I don't have any timeline constraints. I'm very unconstrained. So I may be in and out of it a couple of times as it goes through. But I think the big picture, though, talking the rest of the year, you're really looking at a major inflection point here of, are we going to go into a recession? Because the stock market obviously is the leading predictor of a recession. And I think the stock market and the yield curve, the 10-2 yield curve is suggesting that, we will probably have a recession. If there is a recession and, and things slow down and you get more slowing and especially inflation goes up, then you're probably going to have more of a prolonged bear market. And it could end up being something more like a 2008 or, I run a lot of analog charts. I actually, a game changer for me was 2007, 2008, 2009. I had already gone through the bear market from 99 to 2000,
Sure.
2001, 2002. And I was very successful through that period by and large, because I was doing relative strength and a lot of stuff that, comparing stocks versus bonds. And it just said buy bonds. Well, I bought bonds. Well,
Which was a great trade for like 30 years.
Yeah, it was incredible.
Right.
And I didn't necessarily stay in them that long, but I was doing enough. I was doing relative strength work back then, and everything that I was doing was telling me that stocks are, trending down, bonds and other things are trending up, and also value, small, mid value in the early 2000s became strong because it had lagged so bad in the late 90s when I started. Growth was the thing. Well, value actually went up. And so that was, it was funny at the time. It was almost like dumb luck because I was really enthused with this relative strength of comparing, say, a stock index versus a bond index, and whichever one is trending up is the one I want to be in. Well, the market was literally leading me into where to go. And that's what I do today, but it's just that I've automated it and systematized it and made it far more robust. And the way that I do it is much more defined. And so I think if we do get into recession, we're going to have a prolonged bear market. This could last a couple of years of, and what's going to be tough on everybody is, I executed through the 2008 one though, really, really well. And it was a whole lot of in and out trading, a very broad opportunity set, and I did well during that time, which was a major crash. And that was a time when there just wasn't very many people who did. And I did well based on skill and an edge because it was based on a large sample size of trades. It wasn't just like I got out one day and got back in 2 years later. It wasn't a one trick pony. It was truly looking at asymmetric risk reward and focusing on asymmetry during that time. And that's what we're doing now. I don't necessarily do any better than everybody else when, say, the stock market's doing well. I don't necessarily do that much better unless I'm more focused. But when the markets get really rough like this, though, is when I get dialed in and I start to show the edge in what I do.
I think you could probably safely say that your RSI is pointing higher, which is great. So, well, Mike, this has been great. I'd love to have more conversations with you. But before I let you go, tell us a little bit about Shell Capital Management and what you guys do over there.
Well, Shell Capital is, I was previously, before I started Shell Capital, I was a registered principal and registered options principal at Raymond James here in St. Petersburg. I'm in Tampa, Florida right now. We have an office in Knoxville, Tennessee, and in Tampa Bay, and we're in Tampa Bay most of the time now. But I was a principal at Raymond James, and I started my firm to run the asymmetry investment program, which is what we do now for the last, 18 years, been since 2004, so about 18 years. And, we just manage money for a smaller group of like-minded people who get what we do and appreciate what we do. And it's just a very focused boutique firm. I mean, we're very, very active, and we're not the typical, we're more of a, the hedge fund style, trend following, counter trend, options, and some of the things we do. I've traded options a lot in the past, but it's it's mostly individuals. We went through a period of about a decade. We were managing money for other financial advisors. So that was kind of a big deal for us, and that was our focus really the last decade until here in the last year. I've kind of wound down some of that and gotten more focused. Preparing really for what could be a prolonged bear market. Because
all right, and more wealth management style with individual people. So that's great.
We've had this. We've had these certain families that we've managed their money, for a very long time. I mean, I've got clients that have been my client for over 20 years or 15, 20 years. And that's always been our core, our main purpose, our mission. Our mission is to help them survive and thrive. And, And, of course, us too, because we're invested in the same exact things they are. So,
Well, Mike, I want to say it's been a pleasure meeting with you today. I want to invite you back in the next couple months, see where we're at, as we head into the fall, and see where your opinions are at as far as the markets go at that point. Sound good?
yep, sounds good.
All right. Hey, Mike, thanks for spending time with us today. And if you like what Mike had to give you here on Trader Summit, make sure you give him a thumbs up if you're watching us on YouTube. And also make sure that you subscribe to the channel so you don't miss any of our great exclusive content. Thank you very much for spending your time with us, Mike.
All right. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.